Have you ever heard more experienced traders say you should scale in and out of your trades? Well, when you're first getting into the markets, you don't know when to do that and when to avoid it. So that often leads to you just adding into any position whenever. In this video, I'm going to share with you a quick, comprehensive guide on when to scale into trades, when to scale out, and when not to. So grab your notebooks and let's get into the video. So guys, as usual, we're going to go over pyramid entries and we're going to cover a couple things before we get into some of the actual examples. So obviously learning how to pyramid into and out of positions can add a tremendous amount of profits to your bottom line if you do it properly. And where I messed up, and where I believe most traders will start messing up, is when they hear other experienced traders say, you should start scaling into your trades, but they're not doing it in a proper way, and it just leads to them over leveraging. They're scaling into the wrong positions at the wrong times, and then they have this massive trade that they can't manage, and they can't emotionally handle that type of challenge. Let alone putting one position on, putting on multiple positions inside the same asset can be difficult if you don't know what you're looking for. So obviously, the proper areas to add to your trades will be laid out to you if the market suggests it. And if it does not provide logical areas to add, then we won't add to our trades. And this is the whole point of me using the ICT market maker model, because when I get into the examples, you're going to see exactly why there's certain areas where we can add, and then there's certain areas where we want to avoid adding. So don't just open up a position and then start pyramiding into the trade when it's, you know, 1 5-minute candle going in your direction. All right, we need to have some logic behind why we're adding into a position, and it really comes from a couple different things. So we have logical areas to add into our positions, which is newly created market structure, right? Newly created fair value gaps, breakers, or mitigation blocks. These are really only the 3 areas where we need to add or can add. I would also add OTE because you guys will notice that we do have certain market conditions where we have deep pullbacks, right, where we're possibly trading to a high resistance liquidity run. That is when we're going to get those OTE setups. If it's a low resistance liquidity run, you might not get those pullbacks. Just something to note. So keep that in your notes. You know, if it's a low resistance liquidity run, you might not get pullbacks to OTE. You might just get a consolidation and then a run higher. And the 3 examples that I'm going to share with you at the end of this video is going to help you determine, you know, which areas are going to be best for me to add. Is this just a consolidation, or should I expect a deeper pullback? So obviously the best places to add will be at the beginning of a market maker model. And when I review my total open exposure, I never wanted to exceed a certain threshold. So that's going to be 1R in my case. You might have a more aggressive approach, or a more, I would say, a risk tolerant approach. Or you might have a more conservative approach, where you might only want to risk half an R, right, when you're scaling in. So when I'm adding into my positions, I always want to make sure that whenever I add, no matter what happens, if I take a full stop out on all those positions, every single one of them, that I'm only going to lose 1R. And I'll get into the management side of things once we start diving into when I'm adding. So if I'm only able to reduce my stop loss to 0.5R, then I can only add another 0.5R to the position. So that means if my stop loss, the next logical level, it's only reducing my risk by half an R because I can't get my stop to break even. And I'm not talking about just jamming your stop up for the sake of making the trade break even. That, in my opinion, is not the proper decision. The proper decision should come from your analysis of the market and a logical area where you can actually place your stop loss where the trade no longer makes sense. Now, if I'm just jamming my stop loss up and it doesn't make any sense, then I'm really just doing it out of emotions, fear of losing, so I don't want to give back what I'm up on the trade. Me jamming that stop loss up to break even where it doesn't make any logical sense to, you know, that's kind of where a lot of traders will get knocked out of the trade, and then the trade will continue in the direction. So making sure that we have one of these things happening. We have either a new market structure point, so that's either a new high or low being created, where it's possibly protected. Then we have newly created fair value gaps, right, or breakers or mitigation blocks. Okay. So again, when I review that total open exposure, I only want to risk 1R total. So that means if I put 1R on, I need to get my stop to break even before I add anything into the trade. Or I need to calculate how much open exposure I will have if I add into the trade. So if I'm at 1R and I can't move my stop, then I can't add anything else, right? Because I'm already maxed out on the total open exposure that I want to have on that position. All right, so if I'm able to reduce my stop by 1R, break even, then I can add another 1R to the position, etc., etc. So this can go on and on and on, right? It doesn't just have to be 2 positions only. You can add as many positions as you want, as long as that next position, say it's my third time adding into the trade. If I can get my second entry now to break even, and now both are at break even, possibly, right? It allows me to add a third position at another 1R. All right, and this is how you're going to let your winners run. It'll work on any time frame. It just requires you to spot the market maker model much quicker on the lower time frame, which I'm not a fan of. Personally, I prefer using at least like a 1 hour market maker model. That way, at least when I'm spotting the consolidations and stuff, I have time to react and think logically where I can place my stop loss, how I can build into the position. Now, that requires you to, if you're trading a futures market, right, you have to hold overnight. Futures prop firms don't let you do it, but if you're trading a personal account, as long as you have that margin, you can start swinging positions overnight. All right. So, another couple considerations. So when we pyramid into and out of trades, so we're going to add into our position. Actually, I'll come back to this. So the first thing that we need to understand is the actual market maker model. Now, this is a market maker buy model. I'll just throw that out there. This is just if you're thinking about a sell model, it's pretty much the opposite. All right. So first thing we're going to consider is we need some type of initial consolidation. And then we need to see some legs lower. So we're going to have distribution, redistribution in the form of a consolidation, another distribution leg lower, and then we might get a smart money reversal where we're dipping down into a possible higher time frame PD array, right? Then we get a market structure shift, which is important. Market structure shift, return to a lower buy, a leg of expansion. Then we're going to get accumulation, right? Another leg of expansion, reaccumulation, and then finally a run to the back to the initial consolidation. Now, I'm going to point this out, and other traders have mentioned this, that this market maker model is not going to appear picture perfect every single time you see it. As long as you have the right idea that there's some initial consolidation that is going to be ran out, and this could happen on a low time frame, right? This initial consolidation could be your Asian range, or it could be your AM session range, and then PM session you're expecting the market maker buy model to occur, or vice versa, right? So this initial consolidation, it doesn't really matter what time frame it's on. This could be the first week of the month, right? This could be the first day of the week. This could be Asian range. This could be AM session. This could be PM session from the prior day. The initial consolidation time frame doesn't really matter. It's just how can we frame this in the right way, as long as we have the right direction on the higher time frame. Because in order to spot the market maker buy model, we need to see this occur, the smart money reversal occur at some high time frame PD array. This is where it's going to be most important, this smart money reversal. And I'll get into the points why when we get into the actual examples. But this is really what we need to pay attention to, or be able to understand that we have a sell side of the curve, right? So this is the sell side. So all of this is the sell side, right? And then we have buy side of the curve. And as we flip to buy side of the curve, we're going to start targeting these specific levels. So as long as we have consolidations, those will be our liquidity pools that we're going to target as far as scaling out of trades as well. But when we're scaling into trades, all right, so these will be our eventual targets. Just keep that in mind. On the sell side of the curve, these will be our eventual targets that we're going to use TP1 and then TP2 up here. All right, so when it comes to scaling into trades, though, the best place to start scaling into trades is when we've noticed the smart money reversal and then our initial entry occurs at the low risk buy. if my first entry is all the way up here at the second stage of reaccumulation, I don't really have enough room for the market to run where I can position myself, let's say 1, 2, 3 times before it hits that final TP2. Okay? Just keep this in mind. When we want to pyramid into trades, this is when we're going to be able to avoid scaling into trades, is if we're late to the trade and that market maker model is almost near completion, then we need to just play conservatively and not scale into the trade. Okay? So once we get our smart money reversal, right, we should see some type of expansion, a market structure shift. This will be our market structure shift. When we get back to here, which is our low risk entry, this will be our first entry. Okay? And then once we get another market structure shift and a pullback or consolidation, then I'll be able to move my stop loss to break even, add into another position here where my stop loss is here, risking another 1R. All right. So if I get stopped out on my second position, it'll just be negative 1R. And then if I get stopped out on my initial position, it'll just be break even. And you could even manage it in a way where that initial position, you're actually going to make some money on. So if you get stopped out at 1R on that second position that you entered, if your stop loss is above break even, you might offset that first that full loss that you just took. So if you took a 1R loss on that scale in entry, you might make some of that back. Let's say if you have break even plus 0.5 on your initial entry. So if you get your initial entry above break even, you can mitigate some of that loss, which is where I think pyramiding into your trades and trade management in general, in my opinion, trade management is where the most of the money is made when it comes to trading. I don't care who you are. I don't care how good your entry models are. If I give 10 traders the same entry model and all 10 of them are managing it differently, whoever can manage that trade the best is going to come out ahead every single time. So if I say that there's no limits on scaling in or scaling out of trades, whoever's able to scale in and out effectively is going to be able to come out ahead much further than the person that just takes, say, one position and just rides that full position to the final terminus point. So let's say if there's a person that takes one position and let's say their risk to reward is 1 to 4. So they're risking 1 to make 4. But then there's another trader that's scaling into trades. This 1 to 4, might end up being like a 1 to 8 because they're able to add in positions and double or triple or quadruple the amount of volume that they're putting in the trade while still not increasing their open exposure, if that makes sense. So when you're scaling into trades, always keep in mind that open exposure that you're putting on the trade. We don't want to just add into trades and assume more risk. That's the last thing that we want to do. We want to assume less risk by managing our stop losses, adding in logic into the logical areas, and letting the trade pan out naturally. So with all that being said, let's dive into some examples here. And just keep in mind that these are all examples on the NASDAQ. This works in any market, any time frame, any asset class. It just requires you to be able to spot them in real time, which is something that's not very easy. All right. So we're not going to understand when a market maker sell model is underway until we get a displacement leg or a smart money reversal, right? So this might have traded up into a higher time frame PD array, in which case we got the smart money reversal. Let's say we missed this displacement leg. Maybe we even took a loss, but now we want to be able to position ourselves in a market maker sell model while we're trading lower. So we can already tell that this first move has already taken out this level of reaccumulation. So if we were able to enter a low risk sell, let's say we were able to enter anywhere up here, here, or maybe even here. And I'm just going to point out that there are multiple areas that we could have possibly sold short at, moved our stop to break even, possibly added in, right? Added in again here, maybe added in again here on a market structure shift. Now, that is up for you guys to go into the markets and practice, but I'm just giving you guys the logical framework of how I pyramid into trades and how I manage my positions, because I'm not just scaling into trades and leaving the stop loss where it is. That's the last thing I want to do. I want to be able to tighten my stop losses, add into the trade, and be able to understand how much risk I have in general. And there was a tool that I used to use on MetaTrader 4, and I got it from the Sonic R thread in Forex Factory, where it would tell me my average price, and then it would tell me the total stop loss, where I know a lot of platforms don't do that. But the one thing I liked about it was every single time I added, it would adjust my stop loss, and it would tell me how much I would lose in total if the market came around and stopped me out of all my positions. That was something that I really missed as far as MT4, and I still can use it if I just trade on Oanda, but MT4 is getting kind of outdated, and maybe there are other tools out there. You know, if you have a tool that does that, where it gives you the average stop loss once you're scaling into trades, you know, drop a comment. I'm sure everybody in the community would love to hear from you. And getting back to when to scale into trades, right, where to have our take profits. So let's say our first entry is here, and maybe I'll just make this a permanent level here. Let's just say our permanent entry is, oh, that didn't work. I'll use a pen here. Well, let's say our first entry is here. Let me just make this red. Our first entry is somewhere in here. All right, and our stop loss, let's say, was right here, and then our take profits down here. So just keep in mind that this is a stop loss, this is our take profit. So that is a pretty decent risk to reward, right? So once we're in our initial entry, so just mark this as 1. Now let's say we get a market structure shift. That's a pretty awful one, but let's just say we were able to enter here, right? So this is our entry. And then we got another market structure shift down here. And then we wanted to get short again on this OTE retrace. So you can see that this run lower, we have another position entry here. So let's say you just entered anywhere in here, and just keep in mind that I believe this is on an hourly chart, by the way. So it's giving you a lot of time to be able to predict this move, and it doesn't necessarily have to be this 1 hour candle or entering short. It could be this one, this one, this one, this one. It doesn't really matter. Anywhere in here, after we get our OTE entry, is going to be important, because now where does my stop loss go? So my initial stop loss on my position, this stop loss can now be moved down here where my entry was. So this is my stop loss, my new SL. That's my new SL. My entry for my second position is here. Let's say it's here. And now my stop loss can go where my initial entry was. So if I get stopped out on my second entry, and here's my take profit 1, same area, take profit 2. Just also keep in mind that when you're scaling into your trades, the latter entries might not get the best risk reward. So your initial entry will typically have the best risk reward, and then as you're scaling in, the risk reward gets less and less. So it's okay if you don't want to risk a full R on those second positions or third positions. And I know ICT does that. He'll go heavy on the first position and then start slowly adding in on his next his following areas where he's scaling in. He's not adding another, you know, let's say if he's doing 6 contracts, he's not doing another 6 contracts on the next entry. He might do 6 contracts, then 3 contracts, then 3 contracts, and then 3 contracts to get him to a total of 15 contracts. Okay, so that second entry after this market structure shift, let me mark this as market structure shift just so you guys don't get confused. This second entry, my stop loss is now at my entry. Okay, so if I get stopped out on my first one, it's a break even. If I get stopped out on my second one, it's a negative 1R. So in total, I'm only losing 1R. I'm not losing 2R. I do have 2 positions on, which means if it goes to my target, I'm making almost twice as much as if I were to just take 1 position, right? And this is where the power of compounding into your positions and managing the trades appropriately is going to be so vital. Now, let's say we haven't gotten to our final TP and the market is moving the way we want it to, right? We see another level here. This is another level where we could possibly add into our position, right? Even after we've taken out the second, our first take a profit level, because we have this consolidation. and we still haven't reached our final terminus point, which is this initial consolidation. So what we're able to do is possibly move all of our stops. Maybe we're going to move all of our stops down here. And let's say we didn't want to take profit off. So it ran past our TP, and let's say we didn't have a mechanical take profit in place, like an actual order in the market. So it was just a mental take profit. So let's say if it ran through our take profit level and we still have both our positions on, well, now I can move both stops down to here. And if I get stopped out, right, both these trades will be in profit, but if I add in another one in here, put my stop loss here, right, my entry here, then my final take profits down here, you can see that this is still good enough for a possible 2-to-1 on my third entry. Sorry, I'll say 1-to-2 as far as risk reward. So on that final entry, you guys can see that there's still favorable risk reward there if I'm able to move my stops and manage that trade effectively. So that's the first example. Second example is a bullish example, and you guys will be able to see that there is a much deeper pullback where we can have our lowest buy. But as you guys notice, when the market is in a more of a low resistance liquidity run, we are not getting those deep pullbacks. It will possibly just run straight through to our targets, in which case we will just have to use tighter stop losses, points of, if we don't get in the trade and it's just running in our direction, either you have to kind of leave the trade alone, or we're just going to have to use tighter stop losses and just assume that these lower time frames will be able to hold in place. And I'll go over exactly where you might add into specific trades. So, right, we have our initial consolidation, redistribution, and I will point out that this chart is sloppier than the other one, but it is still the same idea. You might not be able to spot it real time, but this is where your practice comes into play. So when we get this smart money reversal, this is our first indication. So as soon as we get some change in state of delivery, showing buyers and showing that the market may want to trade higher, this is when we're going to start hunting possible ways to pyramid into our entries. So this will be our market structure shift. So we're not getting the market structure shift until we take out that high, right? This is obviously a balanced price range, but we're not covering that in this video. These will be our take profit levels on the sell side of the curve, right? And when we hit our buy side of the curve, where are our possible entries going to be? Well, I would say either our possible entry is possibly going to be here or here. So if we miss this one, we can possibly get in on this one. And then let's just say your stop loss is there, right? So there's your entry and then your take profits up here. So there's our initial entry. Now, where can we possibly enter again? I would say maybe at the break of this. Oh, I just lost connection for some reason. Maybe at the break of this high. So we have another market structure shift here. Or we have equal highs up here, right? So you might want to enter on this candle as an immediate rebalance, right? And then our initial entry, maybe we're going to get our stop loss here. So on that initial rebalance, maybe our stop loss is going to be all the way down here at this swing low. So maybe we're going to use this swing low as our next stop loss point. Our second entry, that's where our stop loss is. And then our first entries are either a break even or above break even. All right. And then maybe our third entry might be here. This one is a little bit iffy because it's just a shallow run on stops and it's not a real deep retracement. This is an immediate rebalance of this candle coming in. This is actually a mitigation block. So if you extend this candle all the way across, this will be our mitigation block, right? Because we didn't take out a low, but this is our mitigation block. So I'm just going to put MB here. And I hope you guys are noticing that these are all areas where, I noted logical areas to scale into our trade and scale out. But what I will note from an example where we want to avoid is when we're getting close to this initial consolidation. So when we're already up here and we've already missed all of this leg down here where we missed the smart money reversal, and we're already at TP2, let's say, on the curve, we're already way too far extended for us to be able to scale into the position. Unless we're zooming all the way out, this might be a level of reaccumulation prior to running higher, but we're not looking at that currently. We're just looking at what's in front of us. Oop. So if we look at what's in front of us, right, we can only see that we're getting 3 different days where we can scale into our trade, which is still a decent amount of time, right? This is on an hourly chart. You just have to be able to spot these points of smart money reversal, and then being able to position yourself and then hold throughout these retracements, and then scaling in, having the confidence that it is going to reach above these levels in here, because this is a low resistance liquidity run. All right, and I'm covering a lot of things. Oh, I can't spell. This is it's supposed to be an L. Low resistance liquidity run. All right, our final example is another market maker buy model. And I would say this one is probably just as sloppy because we're not getting some real solid levels of accumulation going higher, right? It's very sloppy in here, but we do have points of distribution that we can target as far as our take profit levels. Okay, so we do have TP1, TP2, or even TP3 up here. So you might have TP1. You might even have TP1 here if we get a smart money reversal here. If this is your smart money reversal idea here, then you want to maybe even entered on the turtle soup. Maybe you entered on the turtle soup down here, and then you had your, let's say this gray box was your long tool. Maybe you could enter it again here, and maybe here and on an OTE, and then you're just going to exit here. So maybe this is your initial consolidation, right? And this is all discretionary. You guys will be able to understand which consolidation it is that you're targeting. And in my opinion, you should have a level of accumulation or consolidation that you're trying to target. Because you could even say that this one over here is your initial consolidation that you want to target. And let's say this is your smart money reversal here. This, this massive run here is your smart money reversal, and then this was just a shallow run on stops, right? Maybe there's lower time frame information here where you can scale into the position, right? I can even say that right here would be a lower time frame level of reaccumulation, as well as here a low time frame level of reaccumulation. So even if you entered it here as your initial position, say this is 1, you might want to enter in here 2, and then maybe 3 here, and then maybe your initial your terminus target would be here. So this is TP3. Or whatever number TP it is. That's just your TP, your terminus point. But if we zoom back out, obviously there's a much larger market maker buy model occurring here. So this is just another example of, you guys can go back into your charts and study how you would enter your trades and just get used to practicing it real time. And when I'm talking about practicing these concepts real time and getting used to making these adjustments to your trade management, start small. Don't start out and try and do 1R, 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 because you're going to drive yourself crazy. There's a lot of risk to take on. There's a lot to manage emotionally. Maybe you want to just say, all right, I want to scale down and just say, I want to use wider stops and just try and predict this market maker model and how I can pyramid into this entry. And that's kind of how I learned. I learned on the higher time frames, giving myself wider stops, giving myself way more time to position myself in a trade, because you guys can notice that, this market maker model occurs from the 22nd of April, and it doesn't end until almost a month later, right? This does not end until almost a month later. So being able to spot these and trade them, they're two totally different things, right? And this is why I think trying to pyramid on the lower time frames takes a lot more focus, and it takes a lot more skill in determining all the data that you're seeing, because when it's occurring very quickly, it makes it much harder to anticipate how deep are these trades coming against me, where are my stops going to be in a logical area, right? It's not giving you a whole lot of time to determine all of that. But if you're able to think quickly and you're able to see the terminus point, right? If you have a specific idea in mind, and this could just be as simple as, this is my Asian range, or let's just say this is even the midnight open. Let's just say that your initial consolidation occurs at midnight open, and this is what we're seeing leading up into New York session or AM session. And then we see a low risk buy, right? Maybe this is even pre-market, and then during session hours, you're getting another entry, another entry here, and then you're just looking to run out the high of the Asian range, right? Or the midnight opening line. It's as simple as that. And that's typically how I'll scale into trades while I'm trading the lower time frames, is if I know it's going to start approaching that midnight opening price, I'm going to try and position myself below the open if I'm bullish on the day. All right. And that's all indicative of if the market is giving me what I need to see. So if I come to the markets in the morning and it's already trading above the midnight open, it's not giving me a great opportunity to scale into that trade. And those are days where maybe you want to just avoid trading entirely, or you want to just stick to one entry, a low risk entry, and just playing one position. Because if you start trying to scale into your trades on a bullish day while we're above the midnight open, it's going to make your life much more difficult. All right. So to summarize, just a last couple points, right? When to add into our positions. So we want to add into our position at the first stage of accumulation or distribution. So this occurs after the smart money reversal. So after the smart money reversal, our initial position stop loss will move to break even before we add. All right, we need to cut our risk in some measure before we add into our trade. First TP will be at the opposing side, at an opposing side of the curve. You guys can determine that. Maybe it's not the first one that we noticed, because if I bring up the example over here, right, the first part of the curve was already hit on the smart money reversal. So maybe that's not your second take profit, or actually both levels are hit. So maybe your take profit's going to be down here. Or you could just say that, you know, if I want to revisit the lows and this reaccumulation, that's going to be my first take profit, right? Discretionary approach. Second take profit will be at the next opposing side of the curve, etc., etc. So I'll put this in here. And then your final terminus is initial consolidation. So when to avoid scaling in, obviously this should be very clear to you guys. When the market maker model is almost complete and the initial consolidation is near. All right, so when we're approaching that initial consolidation and we don't have a position on, that's the last point where you will want to scale into your position. All right. If you study these videos but still have a hard time applying these concepts in the live markets, don't worry. You're just like me and many other traders that have gone through the same journey of learning and then applying. But if you're looking to speed up the process and get direct access to me, where you can ask me any question, watch me live stream weekly, and avoid all the common mistakes that most traders make, then make sure you book a call using the link in the description. I hope you guys enjoyed the video. Don't forget to like, comment, and subscribe, and I'll see you guys in the next one.